IFRS 16 leases introduced a single accounting model for lessees, significantly changing the treatment of lease transactions in financial reporting. The standard was developed to improve transparency by ensuring that lease obligations are reflected on the statement of financial position rather than being hidden through off-balance sheet accounting. Under IFRS 16, lessees generally recognize both a right-of-use asset and a corresponding lease liability at the commencement date of the lease. This approach reflects the economic reality that lessees obtain the right to control and use an asset while simultaneously incurring an obligation to make lease payments. The standard enhances comparability between entities and provides investors with clearer information regarding financial leverage, asset utilization, and long-term contractual commitments. For lessees, the right-of-use asset is initially measured at cost, which includes the amount of the lease liability, initial direct costs, lease payments made before commencement, and estimated dismantling or restoration costs. The lease liability is measured at the present value of future lease payments discounted using the interest rate implicit in the lease or the lessee's incremental borrowing rate. After initial recognition, the right-of-use asset is depreciated over the lease term or useful life, while the lease liability is reduced through lease payments and increased by finance costs. This accounting treatment results in separate depreciation and interest expenses rather than a single lease expense, affecting profit patterns and financial ratios throughout the lease term. Although IFRS 16 generally requires capitalization of leases, the standard provides important recognition exemptions for short-term leases and low-value assets. Short-term leases are leases with a lease term of 12 months or less and without purchase options. Low-value assets include items such as laptops, office furniture, or small office equipment. When these exemptions are applied, lessees may recognize lease payments as an expense on a straight-line basis over the lease term instead of recognizing right-of-use assets and lease liabilities. These practical exemptions reduce administrative complexity and compliance costs for smaller or less significant lease arrangements. However, entities must apply these exemptions consistently and disclose their accounting policies appropriately within the financial statements. Sale and leaseback transactions require careful analysis under IFRS 16 because they involve both disposal accounting and lease recognition. In these arrangements, an entity sells an asset and immediately leases it back from the buyer. The accounting treatment depends on whether the transfer qualifies as a sale under IFRS 15 revenue from contracts with customers. If a valid sale occurs, the seller lessee recognizes only the portion of any gain related to rights transferred to the buyer lessor, while continuing to recognize a right-of-use asset representing retained usage rights. If the transfer does not qualify as a sale, the transaction is treated as a financing arrangement rather than a genuine disposal. This guidance prevents artificial profit recognition and ensures that financial statements reflect the economic substance of transactions accurately. From the lessor perspective, IFRS 16 largely retains the previous distinction between operating leases and finance leases. A finance lease transfers substantially all risks and rewards associated with ownership of the underlying asset to the lessee. Indicators include transfer of ownership at lease end, bargain purchase options, lease terms covering major portions of asset life, or present values approximating fair value. Operating leases, in contrast, retain significant ownership risks and rewards with the lessor. This distinction is important because it determines how lessors recognize lease income, assets, receivables, and risks. Proper classification ensures that financial statements faithfully represent the economic characteristics of leasing arrangements and their impact on lessor operations and profitability. Accounting treatment for lessors differs significantly depending on lease classification. In finance leases, lessors derecognize the leased asset and recognize a net investment in the lease, representing future lease receivables discounted to present value. Finance income is recognized over the lease term to reflect a constant periodic rate of return. In operating leases, lessors continue recognizing the underlying asset on the statement of financial position and depreciate it according to applicable standards. Lease income is recognized generally on a straight-line basis over the lease term. Operating lease accounting therefore reflects continued ownership and exposure to asset-related risks. These distinctions ensure that financial reporting captures both financing and operational aspects of lease transactions consistently within IFRS accounting standards. Overall, IFRS 16 significantly improved lease accounting by enhancing transparency, comparability, and completeness in financial reporting. The recognition of right-of-use assets and lease liabilities ensures that lease obligations are visible within financial statements and provides stakeholders with more accurate information regarding financial commitments and resource utilization. The standard also balances practicality through recognition exemptions while addressing complex arrangements such as sale and leaseback transactions. For lessors, the continued distinction between operating and finance leases preserves accounting treatments that reflect underlying economic substance. Within the DIP-IFR syllabus, IFRS 16 is important because lease accounting affects profitability, leverage, cash flow analysis, and investment decisions, making it a critical area of international financial reporting and professional accounting practice.